Welcome to Accounting with Professor Lamptey. Today we are going to explain the statement of cash flows. If you are studying for an accounting test, preparing for the CPA exam, or trying to understand financial statements for the first time, this is one of the most important statements you must master. Why? Because a business can report strong net income on the income statement and still struggle to pay its bills. Let me say that again. A business can show profit and still have a cash problem. That is why the statement of cash flows matters. The statement of cash flows reveals the truth about cash movement. It focuses on where cash came from, where cash went, and why the cash balance changed. That is the power of this statement. The income statement shows whether the business made a profit or a loss. The statement of owner's equity shows how the owner's claim changed. The balance sheet shows what the business owns, what it owes, and what belongs to the owner at a specific date. But the statement of cash flows answers a different question. The statement of cash flows answers three questions. Where did the cash come from? Where did the cash go? And why did the cash balance change? Not just profit, not just assets, not just liabilities, cash. So today we will break this down in a simple way. We will explain what the statement of cash flows is. We will explain why profit is not the same as cash. We will cover the three major sections. We will build a complete example, and then we will connect the statement of cash flows to the other financial statements and the accounting cycle. Let's begin. The statement of cash flows is a financial statement that reports cash inflows and cash outflows during a specific period of time. The key phrase is during a specific period of time. That means the heading usually says, for the month ended December 31st, 2026, or for the year ended December 31st, 2026. This is different from the balance sheet. The balance sheet says, as of December 31st, 2026. Why? Because the balance sheet is a snapshot at one date, but the statement of cash flows covers activity over time. It explains how cash moved during the period. Now let's deal with the biggest misconception. Profit is not the same as cash. Net income is calculated using revenues and expenses. But under accrual accounting, revenue is recorded when earned, not necessarily when cash is received. And expenses are recorded when incurred, not necessarily when cash is paid. That creates timing differences. The business may earn revenue today, but collect the cash later. The business may pay cash today, but record the expense over time. So net income and cash flow can be different. For example, suppose a business provides services of $5,000 on account. The business earned revenue, so the income statement may show revenue. But if the customer has not paid yet, cash has not increased. That is why profit is not always cash. Now suppose the business pays $2,400 for 1 year of insurance in advance. Cash decreases immediately. But the entire $2,400 is not recorded as expense right away. Part of it may still be a prepaid asset. Now here is another important example, depreciation. Depreciation is an expense, so it reduces net income. But depreciation does not involve paying cash at the time it is recorded. The cash was paid earlier when the business bought the equipment. So when depreciation expense is recorded, net income goes down, but cash does not go down at that moment. That is why depreciation is called a non-cash expense. Again, cash and net income are not the same. The statement of cash flows helps us understand the difference. It focuses only on actual cash movements, cash received, cash paid, cash increases, cash decreases. Now, the statement of cash flows has three major sections: operating activities, investing activities, and financing activities. Think of them as three buckets of cash activity. The first section is operating activities. Operating activities show cash flows from the normal day-to-day operations of the business. This includes cash received from customers, cash paid to suppliers, cash paid for salaries, cash paid for rent, cash paid for utilities, cash paid for interest, and cash paid for taxes. Operating activities are connected to the main business operations. If a consulting business receives cash from clients, that is an operating cash inflow. If the business pays employees, that is an operating cash outflow. If the business pays rent, that is also an operating cash outflow. Operating activities answer this question. Did normal operations generate cash or use cash? The second section is investing activities. Investing activities show cash flows from buying and selling long-term assets. This includes buying equipment, buying land, buying buildings, selling equipment, selling land, or selling other long-term investments. For example, if the business buys equipment for $6,000 cash, that is an investing cash outflow. Why? Because the business used cash to acquire a long-term asset. If the business sells old equipment for cash, that would be an investing cash inflow. Investing activities answer this question. Is the business buying or selling long-term assets? The third section is financing activities. Financing activities show cash flows between the business and its owners or creditors. This includes owner investments, owner withdrawals, borrowing money from a bank, repaying loan principal, issuing stock, and paying dividends. For a sole proprietorship, owner investment is a financing cash inflow. Owner withdrawal is a financing cash outflow. Borrowing from a bank is a financing cash inflow. Repaying loan principal is a financing cash outflow. Financing activities answer this question. How is the business being financed? Now let's build a simple example using Lamptey Consulting for December 2026. Assume the business had the following cash activities. Cash received from customers, $15,000. Cash paid for rent, $2,000. Cash paid for salaries, $5,000. Cash paid for utilities, $800. Cash paid to buy equipment, $6,000. Cash received from owner investment, $10,000. Cash withdrawn by owner, $1,500. Beginning cash balance, $4,300. Now let's organize these into the three sections. First, operating activities. Cash received from customers, $15,000. Cash paid for rent, $2,000. Cash paid for salaries, $5,000. Cash paid for utilities, $800. Now calculate net cash provided by operating activities. $15,000 minus $2,000 minus $5,000 minus $800 equals $7,200. So operating activities provided cash of $7,200. Next, investing activities. Cash paid to buy equipment, $6,000. That is an investing cash outflow. So net cash used by investing activities is negative $6,000. Next, financing activities. Cash received from owner investment, $10,000. Cash withdrawn by owner, $1,500. $10,000 minus $1,500 equals $8,500. So financing activities provided cash of $8,500. Now let's combine the three sections. Operating activities provided $7,200. Investing activities used $6,000. Financing activities provided $8,500. So the net increase in cash is $7,200 minus $6,000 plus $8,500 equals $9,700. Now we add the beginning cash balance. Beginning cash was $4,300. Net increase in cash was $9,700. Ending cash is $14,000. This ending cash is very important. It must match the cash balance reported on the balance sheet. The statement of cash flows explains how cash changed. The balance sheet reports how much cash the business has at the end of the period. Now let's remember common mistakes. Net income is not the same as cash. Buying equipment is an investing activity. Owner investment is not revenue. Withdrawals are not expenses. And borrowing money is not revenue. Now let's summarize. The statement of cash flows reports cash inflows and cash outflows during a specific period. It explains why cash increased or decreased. Operating activities show cash from normal business operations. Investing activities show cash from buying and selling long-term assets. Financing activities show cash from owners and creditors. The statement calculates the net change in cash, adds beginning cash, and ends with ending cash. That ending cash should match the cash balance on the balance sheet. So when you look at a statement of cash flows, ask 3 simple questions. Did operations generate cash? Did the business buy or sell long-term assets? And how was the business financed? That is the statement of cash flows. If this lesson helped you, subscribe to Accounting with Professor Lamptey, hit the like button, and leave a comment with the accounting topic that confuses you the most. In the next video, we will bring all 4 financial statements together and show how they interconnect. We are breaking down accounting concepts, simple, clear, and accurate.